All right. Well, good morning, everybody. My name is Alan Jebsen. I'm the Senior Vice President of Fundraising here at StartEngine. And welcome, everybody, to our latest webinar titled Cash is King. Before I introduce our guests, I want to go over the agenda for the hour. We've got a packed hour planned for everybody. We will start with Howard Marks, our CEO at StartEngine, and Mr. Wonderful himself, Kevin O'Leary, for about 20 minutes this morning to start the webinar and talk about why we are here, why it's titled Cash is King, and the current market climates. And then Kevin O'Leary, of course, a very busy man, so he is going to drop off, and we're going to be joined with Jeff Annison, our co-founder and president of Legion M, a company that has raised very successfully in the past in equity crowdfunding and has an upcoming raise on StartEngine, who is an expert in talking about, from a founder's perspective, their perspective on StartEngine and equity crowdfunding. And then about 10 minutes to go into the hour session, we are going to open up the floor to questions from the crowd. So please, throughout the webinar, submit the questions through the Q&A button you see on the Zoom chat. We have colleagues at StartEngine who will be combing through the questions and bubbling up the most topical ones for me to point out and to get Howard and Jeff's answers on them. So please feel free to answer or to ask questions throughout the raise. But Kevin, I know we don't have you for too long, so I want to start off by welcoming you. Thank you so much for joining us here today. We're so happy to have you. First question for you and for Howard is, why is cash king? We're talking about the market climates. We wanted to bring you on to hear your experiences with yourself and your businesses and your founders navigating these times. It's a bit of an unprecedented, uncertain time for founders in the current market climate. So the first question for you is, why is cash king, and how do you recommend founders navigate these times?
You know, I like to go back in history to try and draw analogies to the situation we're in today. Of course, no two different times are exactly alike, but let's take a stock that everybody knows, a company that everybody knows. It's been around almost 20 years, Amazon. When Amazon burst on the scene, it didn't have a lot of institutional investors. It was a startup that just sold books. Most people remember that. And when it went public, its stock was incredibly volatile. The first 17 years, drawdowns were 38 to 58% every 11 months. And I know that because I owned it all the way through that period, and their pref shares as well. And the reason that was happening was that the market would shift its focus on free cash flow to sales growth. It was constantly a battle between how fast could they raise their top line versus how much cash did they make. Sometimes the market cared about the cash, sometimes it cared about the growth, but it rarely cared about both simultaneously. And on the massive sell-offs, it would all of a sudden say, well, it's not profitable. In fact, it made the front page of Barron's magazine as a bust. That was probably, I don't know, $100 billion worth of market cap ago or whatever. But the point is, we're at a cycle now, where cash matters again. And your burn rate matters, and how much cash you have in the bank until you go to zero, calculated by your monthly burn. That didn't matter just 6 months ago. And so when it matters, it really matters. And so it's changing the tone of the market dramatically. People are not willing to just buy sales growth anymore. They want free cash flow. And in some cases, they really covet distributions, which is coming back into fashion again. And at the same time, you've got wild swings in the market for obvious reasons. People are concerned about inflation. But the cash is king is a great name for this seminar today, this conversation, because that's exactly what happened. In a matter of 90 days, cash became king. Hail to the king.
Yeah, I agree with you, Kevin. One of the things as an entrepreneur for 40 years I've learned, you never have too much cash. No, you don't have too much cash. I mean, unless you talk about Microsoft, fine, but that's an exception. And the reason is because if you want to grow, you're going to need cash to grow. If you don't want to go out of business, you want cash so that your employees, your customers know that you have a runway that is long enough that they don't care. So some people say 18 months runway, which means, like, as Kevin was explaining, how much do you burn a month? Do you have enough for 18 months? I think 18 months is not enough, frankly. But okay, if that was the marker, true. But then in 6 months from now, do you still have 18 months, right? 6 months from now, you may have only a year. And then when you get down to the last 6 months, you're running very fast into the wall and you're done, because people are going to pick you up for nothing. And the terms you're going to get are so insane, you're not going to even believe it. I mean, you're seeing that with the crypto companies right now. The terms that are being offered for cash is so insane. 90 days ago, they would have been laughing at those offers, but today they may be taking them. So I think in this environment, if there's a way for you to raise capital, this is a great idea. Very good. Now, unfortunately, when cash is king, it's hard to raise money. It's very hard. So here we're here to talk about some good ideas.
Yeah, so I guess that is my next question for you, Kevin. I mean, you've invested in over 50, 60 companies in your portfolio, probably even more in your lifetime. I'm sure during these times, your founders are coming to you and say, help me, what do I do? What's next? What do you first recommend to your founders who are saying, listen, I get the message, cash is king, I just need it. How do they navigate these times?
Well, you have to look at multiple finance options. Obviously, some have access to debt, which in its own has its own problems. Most don't, actually, that are in the startup phase. And then, of course, many have turned and started to experiment with equity crowdfunding, which really has come on its own in the last 36 months, because there's lots of examples of companies that have done it successfully. And so traditional sources of financing now, hedge funds, private equity, and venture startup companies, have some tough decisions because they have existing portfolios. And this is one of the challenges that any venture fund has. They've got maybe 12 to 20 positions on, of which maybe 4 companies are worth financing and the rest are not. And so they have to make this very tough decision. Do we go back in to keep them alive, or do we cut them loose and just support our winners? And it's so hard to pick winners very early on, but that's the kind of discussion that's going around the table now in venture funds. And they're not really looking at new deals too much because they're trying to figure out how to protect their assets and mark to market for their LPs what the fund is worth. So this often happens. It's not the first time. It's not the first rodeo for these people. But it does dry up capital a little bit in terms of making it easy to raise money. The traditional $5 million, at a $5 million pre, whatever, those things are much tougher now, much tougher, which makes it kind of interesting for equity crowdfunding. One of the reasons that I like StartEngine, and I have to disclose I'm a shareholder and a paid spokesperson, but we've used it for my own portfolio companies. But the one thing you got to understand is you can raise multiple dollars in very small increments on equity crowdfunding, which is much easier to do in tough times. Doesn't mean it's going to be wildly easy, but instead of having to ask LPs for $50, $100, $200, $250,000, you can run around asking for $200 to $2,000 from 100,000 people and try and get 4, 5, 6, 7% of them each week to invest because you have a good story. Primarily getting your customers to invest at this point in time is the easiest thing to do because they already know the merits of the product or service. Having them become shareholders is a good thing because they have a long-term view if they're going to remain users of the product or service. And the only platform that can do that is equity crowdfunding. You can't get this from your VC. No hedge fund can do it. No private equity firm. That's why I think in tougher times, we may find that more companies attempt to raise capital using equity crowdfunding than any other source.
This is probably a great moment for equity crowdfunding right now, because there was still a lot of skepticism out there. Why should I do equity crowdfunding? I can just go and get a check from a VC. The terms are not that great. I have to give up control and I have to give them a return that is above what I have. And so I may not make any money down the road, but okay, I'll do the deal because I get a check. How easy is it? I grab a check. Equity crowdfunding, you can't grab a check. You have to do a little bit of more work. But I tell entrepreneurs, If you're going to go pitch 30, 40 VCs to get one deal, maybe that's hundreds of hours anyway. You're going to spend hundreds of hours pitching investors, where with equity crowdfunding, as you pitch investors, you actually grow your business. You can get more revenue for your company. So in some ways, this is our moment right now. Our moment is now.
Well, thank you, Howard. And Kevin, question for you. And we get this, Howard and I get this from founders all the time when we're speaking to them about deciding to raise money via equity crowdfunding. And we're seeing some questions come in about the actual term sheets. Okay, I want to look at equity crowdfunding. I'm interested and I understand I've got a raise right now, but what terms can we set? Is it truly a less expensive route for the founders compared to institutional and venture capitalists? What have you seen in the marketplace, and how would you advise your founders to navigate pricing their rounds, especially in this current climate?
It's not so much the expense that they should be focusing on, because expenses are relatively the same across all opportunities at the end of the day. It's the control provisions and the features. Usually what happens with traditional venture funds and private equity, and certainly with hedge funds, is they want a proprietary position, a preference share, sitting on top of the founder shares, and sometimes early round investor shares as well. So they're coming in at a time when they're saying, look, we want to be treated differently than the rest of the shareholders because we're just giving you a large amount of capital, or we're buying it at a higher price, or whatever I'm not going to call it an excuse, but the feature sets for VCs are very often significantly different than founders. And so if you're a founder and you want to raise capital, it's not fees you should be focusing on, it's control provisions and preferences. And so what usually works in venture, debt or venture equity when it's done through a traditional firm is, I'm the investor to the LP, and I want all kinds of features that put me ahead of returns of anybody else. And I use the venture fund to do the dirty work for that. Well, if you're the founder, that's not good news for you. You use equity crowdfunding, you can offer shares that are identical to all the other shares that are in the company. And you detail that with full transparency, and you market that way, and you attempt to do it in a way that keeps the entire playing field level. That is the number one attribute of equity crowdfunding that you don't get anywhere else. You're rarely going to find a VC that says, yeah, I'll take the same shares that you got when you founded the company. That practically never happens. Never happens with hedge funds. Virtually never happens with private equity. And so before you decide that you're going to focus on whatever the fees are, you better have a look at what the features are and what the covenants are and what the attributes are of the offer being made to you by any of the traditional forms of financing. That's where the rubber meets the road. And that's why over time, more and more founders are saying, wait a second, I can keep control. Number one, I can have features that are just very similar. So it's very easy to understand the cap table. There's no funky chicken, returns that someone gets before I do, or any of that kind of thing. And those liquidity rights that are often asked for, you have to read the fine print, but they can be just brutally expensive to the founder in terms of dilution, which is why I say, have a look at equity crowdfunding. And Howard just said it. This is probably going to be the golden age because we haven't had a real market correction for quite a while, and we're in the middle of one right now.
Yeah, Howard, how do you look at, because StartEngine has done many rounds of crowdfunding, and that's something that I think Kevin has been very interested in. StartEngine actually eats our own dog food, so to speak. We raise capital on our own platform for our business. So Howard, my question to you is, when you look at the terms of our next round, how do you go about setting those terms, and how have you looked at common shares, preferred shares, and different types of rights? Like Kevin mentioned that we're selling the same sort of stock that we have had in the company for years prior.
Well, I have to tell you, I've been running companies for 40 years, and venture capital is one way to finance a company. Of course, when we did Activision, we didn't have venture capital because, first of all, VCs would not invest in a game company at that time in the 90s at all because they saw that as too risky. So we had to go and find money in the capital markets, with a listing on NASDAQ and getting some investors who are willing to to take common shares like Kevin was doing. So we financed basically Activision mostly with common shares, the same we owned. And I think for StartEngine was the same thing. We started a company with a bunch of friends, and we got preferred at that point, but small amount of money, no rights. Like Kevin was talking about those fine print, there was no fine print. And then we started raising money from the crowd because he said, look, we're telling entrepreneurs to go raise money from the crowd. We have to do the same. We can't be disingenuous about it. We have to be the same as everybody. So we went to the crowd, and as we priced shares for multiple rounds, we're on our 5th round right now. Can you imagine? Amazing. We've raised over $60 million for StartEngine in common shares, and we stay in control. When I say we, that's me, my co-founder, Ron Miller. We stay in control. And Kevin, of course, he's a part of our group, and we're in control. So I'm not going to get a phone call from anybody else saying, hey, Howard, I have a great idea. You should sell your company. Or, hey, Howard, I have a great idea. Let's replace you with someone else. I'm not getting these phone calls. In fact, great. Every time I get a phone call, it's an investor who wants my help, or an entrepreneur. And I'm wanting to talk because it helps our business. So we did that ourselves. We've priced our rounds based on demand. What we have found in our last round last year, we raised almost 30 million, is that the demand was very strong. And when we closed the round, we found there was people who wished they could have invested. So then we opened a new round recently. And look, cash is king. We have a very strong balance sheet right now. We already published our numbers last year, audited numbers, and cash and assets was close to 20 million. And then we're going to soon announce our first quarter earnings, then our second quarter earnings. And we've registered our shares. So we're almost a public company, but we're not traded on any marketplaces. And we are living cash is king. Why? Because our run rate is very long. I don't know how long it is because it's hard for me to calculate given that we don't burn much. So Look, we're in a very privileged position. I want our entrepreneurs who work with us to be the same. I want them to feel the same way as I feel. I feel great. I feel really happy right now that I can run our business and not feel threatened at every point of time. When I was early in my career, and I'm sure Kevin was in the same place, I was bankrupt every other month. I don't know. I didn't know. Maybe I was, maybe I wasn't. It was always tumultuous. But now, nope, it's perfect.
Kevin, I know we want to be respectful of your time. So one last question before you have to jump. We get a lot of questions from founders around, okay, I've got a raise right now. I'm going to explore equity crowdfunding, but taking on thousands of people on my cap table seems unimaginable. And more so, how does the institutional rounds, the venture capitalists, view equity crowdfunding for subsequent financing? How do you navigate that question? How do you speak to your founders about equity crowdfunding and specifically having thousands of investors now that you're dealing with?
When equity crowdfunding came on the scene originally out of the Jobs Act, it was limited to a raise of $1,070,000. And what would happen all the time is venture capital firms, hedge funds, private equity firms would say, look, the vehicle's useless to you because it's so limiting. We'll raise you $5 million. You can't do that on equity crowdfunding. Kind of a typical early stage round, $5 million. Well, those days are over because equity crowdfunding now allows a Series A to $5 million. So all of a sudden, it's very competitive because now when you're looking at alternatives, you're saying, I can raise $5 million over here with a VC firm with all of these rights that they're going to have above me as a founder and all of these attributes of liquidity and multipliers I don't have and all kinds of covenants I have to disclose to other shareholders that are already investors in me that aren't going to be happy necessarily with it. Or I can do the same thing on equity crowdfunding, sell the same shares that are pari passu and that don't have any special rights, and in many cases are going to my customer base, which can be very loyal and very sticky. And one other attribute that I point out to people is every fund, I don't care what fund you're talking about, has a time clock on it, generally 5 to 7 years. And so when a portfolio starts to get in, a portfolio company gets into the 3rd and 4th year, the LPs are getting pressure to get liquidity. all of a sudden you in the portfolio, even if your company is doing well, is going to end up being either levered so they can get some liquidity out, or sold, or be under pressure to get some kind of liquidity event. They don't tell you that when you start the journey with them, but you get it in about 36 months later. And you can talk to any, entrepreneur that's been down that road. There's nothing wrong with it. Nothing wrong with venture capital funds, nothing wrong with hedge funds, nothing wrong with private equity. But, equity crowdfunding is a new alternative that has some really good attributes that none of the others can even offer you. And so what I tell everybody that asks me about it and why I'm involved in it is I say, check it out. Have a look at it. It's different, but it doesn't mean it's bad. It's different in a good way. And the reason I think it's going to continue to grow as a platform and as an asset class is there's lots of success stories now of companies that have done multiple rounds in equity crowdfunding, a StartEngine, that are successful companies. And word of mouth in the crowd is the most powerful form of advertising. It's the real deal. And that's always going to take time, but now it's starting to happen. So each year goes by, every quarter goes by, more success stories, more companies say, well, I'm going to try that too. It worked for so-and-so. And so for me, we're in the nascent stage here of this, but it's not going away. It's very competitive. I'd kind of say we're in the second and a half inning of a 9-inning baseball game. So lots of good news to come. Anyways, thanks for having me on today. I'm going to hop and talk about crypto now, another place under pressure. They're very interesting times for them too, but it just shows you the market is in volatile upheaval right now. And I think, as Howard said, and it's probably the best theme above cash is king, this is where equity crowdfunding is really going to shine in the next 12 months. Watch it happen. Thanks, everybody.
Thank you so much for joining, Kevin.
Thank you, Kevin.
Howard, so I'd love your thoughts on what Kevin mentioned around the time is now for equity crowdfunding. Of course, StartEngine itself is an equity crowdfunding platform. We're a business that we need to run the platform successfully. We've got our own objectives and our own capital raise goals. How do you approach raising capital in this market, and how has the market conditions affected our approach to navigate these times?
Well, for ourselves, I'm going to talk about StartEngine as the CEO of StartEngine. We planned for this. A lot of people around us, and sometimes even our employees, were asking me the question last year, I don't understand, why are you raising more money? We have plenty of money. And at that point, we had maybe, I don't know, $10, $12 million of cash. And it's like, why are you raising more money? And we're not burning that much, so why are you doing this? And my answer was, look, you never have enough money. To the extent there's money available out there that is interested in making an investment at terms that you find acceptable, you should do it. You should get the money. You should raise the money. Because for an investor in a company, if a company is well-financed, it's a better position. It's more secure than a company that's limping along the way and every time has to keep raising money because in 3 months they're running into the wall. I advise a lot of entrepreneurs, do not do that. Don't go into the mode of, I only have 3 months left of cash. It is so stressful. And sometimes it clouds your ability to think long-term. You have to think short-term, and your employees, frankly, are uneasy about it. I don't think anybody's easy about it. Okay, look, you got these fearless entrepreneurs who will be like, that's the way of life. That's how we are. I understand that. I've been there. But now I'm in a different position, not because I was successful as my previous companies, because I learned the lesson. And the lesson is very simple. You can't predict the future. I don't care. I'm not an economist. I don't predict the future. I don't look at the economy. I don't look at interest rates. I don't look at inflation, because I can't predict. There's one thing I can predict. I can predict that cash becomes king when there's a downturn in the markets. I can predict that. I can also predict when the markets are going crazy, when capital is available, that people would be like, well, I don't think it's a good time to raise because I can get more in 3 months, higher valuation. And then when times are difficult, well, I don't need to raise right now. because no one wants to invest, so I'm going to wait. I think both are wrong. I think both theories are wrong. Raise the capital you need at the terms you find acceptable, and do not wait. Waiting is a false alternative. It doesn't work because you cannot predict the future. Look, I can't predict where StartEngine is going to be in the next 12 months. I cannot predict it. But one thing I can be sure of is that we're well capitalized so that if there's a downturn in the market, like we're seeing today, we can weather it. Now, it turns out in a weird way that right now, it's a great time for us. Why? Because a lot of the sources of capital have evaporated. So it's a great time for us. But we're not having a party. We're not doing that. We're working extremely hard. In fact, we're working harder now than we were working before because we realize that this is our opportunity and we need to take advantage of it.
Yeah, absolutely. Well, it's always great to get your perspective on the downturn. And this kind of leads us very well to our next guest. I'd like to welcome Jeff Annison, co-founder and president of Legion M. Welcome.
Hello. Nice to thank you for having me on your show this morning.
Of course. Thank you so much for joining, Jeff. I mean, you heard Kevin's perspective on why the time is now for raising capital and equity crowdfunding, and you heard Howard's approach to how StartEngine's been able to navigate these times. You're in a very similar position. You have, for those who don't know and are unaware of Legion M is a company that is very much a trailblazer in the equity crowdfunding space. When was the first crowdfunding campaign that you started? I mean, it must have been back in
It was May 16th of 2016. It was literally the morning at 9 a.m. the law went into effect. We were one of the first.
Right. That's right. So you were one of the first companies all the way back in 2016 to choose equity crowdfunding, definitely when it wasn't as popular as it is today. But Jeff, my first question to you is to kind of piggyback on what Howard was talking about around how is you as the president and co-founder of Legion M, how do you navigate these times and what has been your approach to raising capital through equity crowdfunding, and how has that helped you, especially during the current market climate?
Yeah, it's a great question. Well, I mean, by a bit of background, this is the third startup that Paul Scanlon, my co-founder, and I have been involved with. The first one, we raised over $100 million in venture capital for a company called Moby TV, and we went that route. The second company we bootstrapped primarily with revenue. We had probably about $800,000 of investment that we just got from friends and family investors to kind of launch it. But then it was in business for 6 years and just bootstrapping and trying to grow it completely organically. And now with Legion M, we've started that. We're 6 years in. We've raised over $16 million. And we are all in on equity crowdfunding. I've got to say, a lot of this discussion is talking about how equity crowdfunding is a different way of raising money, but we actually think it's a fundamentally different way to build a business. And I think that's where it can become extremely powerful. If you're talking about different ways to raise money, like you guys have been saying, there's advantages and disadvantages to each approach. As Howard mentioned, raising money from venture capitalists is not an easy thing. For some companies, I'm sure it is if you go out there. But I know with Moby TV, the company where we raised over $100 million, we pitched every single, venture capitalist in the Valley and it's multiple times for multiple rounds. And so if you look at the amount of work that you've got to do to raise money from the crowd, like there's definitely work that's involved. You've got to, so much of it is about the marketing and the positioning and how you explain it and get it out there. But the way that I see it is it feels to me fairly comparable to the amount of work that we did fundraising when we were raising it from traditional sources. But where the difference is that unlike with venture capitalists, the ability to sell to your customer base and to build your customer base as part of your fundraising, I think can create advantages that, completely outside of the funding terms that can mean the difference between success and failure for a company. And that's what Legion M is fundamentally all about. It's about how can you unite our consumer base to create a business and to stake out a claim in one of the most competitive but lucrative, if you're successful, industries on the planet.
And Jeff, when you talk about equity crowdfunding, it's really a decision for the company. It's a brand decision. It's a way to build a business. I asked this question to Kevin, and I'm going to get Howard's opinion on it for StartEngine and how we've been able to manage it. But I'd love yours first on I think you've done 8 rounds of equity crowdfunding in your history, and you're about to do a 9th round, and you have over 35,000 shareholders on your cap table. How do you manage those shareholders? It's probably the most common question we get from companies who are thinking about equity crowdfunding is, I don't even, I have a tough time answering my institutional investors calls every other day, but that's only 5 people. How do I manage 35,000? And not only how have you managed it, but how have you leveraged them to your advantage, Jeff?
Well, like I said, I mean, this is fundamental to Legion M as a company. The thesis of the company is that if you unite fans to create a entertainment company, you've got competitive advantages. So, I would say that there's probably, in my experience in talking with other people that have equity crowdfunding and seeing companies that are doing it, there's kind of a spectrum of how you do it. And I just want to start by saying Legion M is on the far end of that spectrum because our company would not exist without equity crowdfunding. And so we lean so heavily into it. And, when we started the company, so many people told us, like, are you crazy? You want to have 1 million shareholders on your cap table? Like, that's insane. And, our response was like, no, like that's what we want. I mean, imagine the power of having 1 million customers, 1 million people invested financially and emotionally in your company. And so, we lean heavily into it. We have a Facebook members only group. We do these things called impulses, which are surveys that we go out. We're an entertainment company, so we do film and television. And one of the chief advantages that we see from equity crowdfunding is that we've got a community of 35,000 passionate film fans that we can harness that wisdom of the crowd to make decisions for the company. It's amazing in Hollywood how many decisions boil down to the gut feel of 1 or 2 executives. And, we feel like there's got to be a better way. And so we work really hard to find ways to leverage and harness the power of our community, whether it's seeking their opinion, whether it's helping them, using them as scouts to help us find new IP, whether it's using them as a focus group when we've got various different versions of things, obviously using them as a springboard when we're going to launch a new product. For us, we do a lot of things. We've had a lot of success in merchandising. And the fact that we've got this community of 35,000 people allows us to take risks that would be really difficult, I think, for a company that didn't have that to do. Because if we want to launch a new product, we know that there's a group of people that are going to very warmly receive it. And oftentimes that allows us to do things like commit to a minimum order quantity that we would not otherwise be able to commit to, and that gets us economy of scale, which pushes the price down, which makes it more likely to be successful. And so those sorts of virtuous cycles. So I think that's the way that Legion M has approached it. I've seen plenty of other founders who have instead rolled up all of the investors into a single entry in their cap table. And I know that there's ways that you can do that. And I think that way could likely be successful too. And there's a lot of companies that have had success. But at the end of the day, I feel what it boils down to is that when you're equity crowdfunding, you need to treat your equity crowdfunding investors the same way you would treat your venture capitalist investors, meaning that you need to take them along for the ride. You need to provide transparency to let them know what you're doing. You need to let them inside and behind the curtain so that they can experience the highs and lows of running a startup. And I think that if you take that approach, at least with communications and the way that you treat them and the way that you explain to them the risks and the decisions that you're making, in my opinion, that's probably the best way to manage it.
Yeah, that makes complete sense. Jeff, question for when we speak to a lot of founders, they always ask, hey, can you introduce us to a founder that has done it before? I want to pick their brain. I want to get their advice. Well, we're so lucky to have you, and we've got a lot of founders in the audience right now. We're probably asking the same thing. If you think back to 2016, what do you think was the most important aspect of your raise that led it to be successful? How are you able to make equity crowdfunding for Legion M successful when you didn't have the audience and the subscribers, and it was the first time that you've done equity crowdfunding? And then subsequently, we get a lot of questions in the chat right now about, okay, great, I'll do equity crowdfunding, but how does that affect me with future rounds with venture capital institutional? So what is the most important aspect to a successful crowdfunding raise in your opinion? And two, what has led you to the approach of doing 7 more consecutive equity crowdfunding raises for Legion M?
Yeah. Well, let me address the second question first, as far as, follow-on VC finance and that sort of stuff. We have not taken any money other than equity crowdfunding. And, we feel like it takes a lot longer to raise money, $100 at a time. But again, for Legion M, that is where the power of the company lies. And we think that is really long-term going to be what makes us effective. I will say this, and Kevin mentioned it earlier, as well as Howard, but VCs are always going to want preferences. And I think that can be a challenging thing to figure out, because it puts you in the position of now you've got, your equity crowdfunding, small investors, you've got your VC, your large investors, and they're not in the same boat anymore, right? Because the VC is going to want preferences and preferential terms and all that sort of stuff. And I feel like that is a really tricky situation to get into. I think that what Kevin said earlier, the power of having everybody in the same boat, right? My shares in Legion M are the exact same financially as every investor, even the person that's only put in $100. And I think that is really powerful when we're all in the same boat. We all win together. We all lose together. The moment you start putting preferences in there, and now there's 2 different classes or 3 different classes or that sort of stuff, it creates opportunities where if you end up in a scenario where it's a zero-sum game, one of those groups has to win and one of them has to lose. And so for Legion M, we've really stuck to the equity crowdfunding because we are so fundamental about it's these 35,000 people that make our company what it is. So we are going to make sure that they have the best possible terms. And the only way that we would ever deviate from that is if something came along that was so good that it was just in everybody's best interest, to kind of make that distinction. And I'm sorry, what was the first part of the question again? Was what was the key back in 2016 that made it successful? That one's easy. Marketing and messaging, right? Because equity crowdfunding, it's like self-publishing a book. Great. You're up on Amazon's shelf along with 11 billion other books. So your question now as a founder, and anybody that's ever run a Kickstarter knows it's the exact same thing there, is how do you get people to learn about your company? How do you get people to care enough about it that they're willing to pull out their debit card and invest $100 or $500 or whatever your minimum investment in the company is? And when we started in 2016, we were just 2 guys, we're jumping up and down, waving our arms, talking about this idea. and we had some success. And, we got, I want to say it was maybe $150,000 worth of investment. And then it would just that was it. We had kind of tapped our, our personal networks and our friends and family and the press that we had got upon launch. And so we started doing some marketing, some Facebook marketing. And, we started off and, if we spent $100 in Facebook marketing, we get $50 worth of investment. And so obviously that doesn't scale. But what we did was we worked on our messaging. Back at the time, it was really tricky because equity crowdfunding was new. Nobody knew what it was. Most people thought it was a scam, and so we worked on our messaging. We worked on our flows. We invited people to join Legion M as a free member, and created this kind of environment where people could come in, get a chance to meet us and see our community, see what we were about. And I think that was really effective because, again, it's really fascinating sometimes because I think that when you look at crowdfunding in general, a lot of times it's almost easier to back something in Kickstarter, right? If you're going to if you're going to back a Kickstarter project for $100, you're going to get a t-shirt and, a pre-sale DVD. When you go invest $100 in that same company using equity crowdfunding, it just scratches another part of your brain. Like, is this a good deal? Are these terms good? Is this a good investment? And so even though you're getting something in equity crowdfunding, which is equity in the company that is fundamentally different, and I would argue better than a t-shirt, it's just people look at it differently. It's harder to wrap your mind around. So anyway, long story short, it's just that old adage of, you've got to figure out your marketing, your messaging, and you need to try things, experiment, and, learn from your failures and then come back again. And ultimately, I think that's really the key to equity crowdfunding.
Yeah.
To be honest, I don't think that my crystal ball is better than anybody else's as far as, this next stage. I do 100% agree with Howard's sentiment that I think we are in a golden age of equity crowdfunding. I think that equity crowdfunding as an asset class is probably far better suited, for a steep recession or that sort of thing than raising money via venture capital and traditional sources and that sort of thing. I think we live in such an interesting time because now suddenly investing in GameStop or Dogecoin or fine wine and collectibles are all asset classes that, for modern investors can kind of take on equal weight as things like stocks and bonds. And, there was a headline that came out a couple of days ago talking about millennials own more in crypto than they do in mutual funds, which I think is just, fascinating. And there's a lot to unpack there because I think there are some of these that are very legitimate asset classes, and really, technology has allowed the common man to invest in things like fine wine and exotic cars that were never possible or startup companies for that matter. That were never possible for the general public before. And so, but on the flip side, there's also crazy things like, GameStop and these meme stocks where it just seems like it's kind of a runaway social phenomena. But I think at the end of the day, it's the fact that, raising money, small amounts of money, I do think it's easier to get a $100 check today than it is a $250,000 check for all the reasons that Howard and Kevin were talking about. On top of that, I think that it's one of the most healthiest forms of fundraising, because at the end of the day, if you think about it, when you're selling to VCs, you're spending an enormous amount of your time figuring out how to position yourself, sell yourself, make your customer work, make your product and business model work for your investors. Whereas when you're doing it with equity crowdfunding, you're doing all those exact same things, but you're trying to figure out how to make it work for your customers. And so it's just a lot of effort that goes into something that, ultimately I believe is more powerful. Because if you can make your product work for your customers, you're far more likely to succeed than just having something that works on paper for investors. So I think that, I always encourage people when they're talking to me to explore equity crowdfunding and look at the different options, because like I said, we are all in on it, Paul and I. And I think one of the things that we're doing is looking at figuring out how to lower our minimum investment. Our minimum investment throughout Legion M's history has been $100. And now we want to knock it down to like $40. And I think that that's a really interesting sort of dynamic, because when you can open the gates for people at that level, I think it has the possibility to fundamentally transform the sort of investors that you're getting. And at the end of the day, I expect that 80% of my money that we raise is gonna come from people writing larger checks, but 80% of our investors are gonna come from people, at maybe the $40 level or $100 level. And I think that that's a really fascinating dynamic. But like I said, I think that for our business and our company, that's the most powerful position that we can be in.
Yeah, totally. Howard, question for you, and Jeff, I'd love your thoughts on this. We're getting a lot of questions in the chat around, and I'm going to be picking out a couple of questions from the Q&A. So thank you everyone for submitting those through the chat and the Q&A button. And the first question comes from Harrison. And Howard, I'd love your opinion of this and how StartEngine is addressing this for their investors and for the platform, is around liquidity or an exit. How do companies on StartEngine approach providing that liquidity to investors? Or how do companies on StartEngine rather show their investors a plan for an exit, whether that's a dividend stream or a liquidity event?
So I think one thing it has to be clear is that equity crowdfunding is an innovation in raising capital, and soon to be an innovation for liquidity as well. Right now, it took us, I don't know, Jeff was talking about 2016. In fact, we started end of 2015 because Reg A was announced earlier than regulation crowdfunding. So we're still talking 7 years. And we were walking through the desert for many years because it was hard to find entrepreneurs who wanted to use equity crowdfunding. Now, it's not hard. It was hard. So Jeff is an absolute innovator in what he's doing, an absolute innovator, because he just saw the opportunity where most didn't. So now today, what we're talking about is, well, the traditional forms of liquidity is what? Well, selling the company, that's one of them. But some entrepreneurs don't want to sell because they love what they're doing and they have a mission. They want to accomplish the mission, and it takes time. I mean, Activision was a 30-year overnight success. I don't know. To a lot of people, that sounds like oh my God, so long. Yeah, well, we had so much fun. So what? And, StartEngine, we're 7 years in, overnight success, but we're not a success yet. We're not there. So maybe in a few years, maybe 5 years from now, we can talk about an overnight success, right? So that's one of the things. You can sell the company. Another one is you can take the company public. And the NASDAQ, New York Stock Exchange, is great for taking a company public, except that a lot of people misunderstand what this is all about. Unless you have institutional research looking at your company and making reports on your company and supporting what you're doing with real research, independent, your stock is probably going to go into the toilet. And why? Because the hedge funds are going to short you into oblivion. They're going to keep shorting, because they make money. Every time your stock goes down, they make money. But the more they short, the more it goes down. I mean, Jeff was talking about the meme stocks, at GameStop, where it did the other way. It was a short squeeze. So basically, everybody was shorting GameStop, and a million people said, nah, we don't believe it. And they kept buying stock. And every time it goes up, the short sellers have to sell at a lower price, at a higher price, and lose so much money at a point where they can't sustain it anymore. And guys lost billions. So Tesla is another example. So that's another way to do it. But I would be careful about going public unless you have support and a very clear path for growth and profitability. Anyway, right now the markets are kind of dead for those options. And the third option is what we're going to be introducing, which is the idea of having a platform like it's called secondary, where you can trade those shares. But it's not like in a stock market. It doesn't have, hedge funds shorting you to zero. It doesn't have puts, calls, all these options. It doesn't have margins where you can borrow money. Sometimes margin, people short stocks, there's more shorts than there are stocks available. I mean, how do you explain that? That's called naked shorts, and it shouldn't be legal. I guess people do it anyway, but so strange. But anyway, we wanted to create our own marketplace that is clean. And I was inspired by the video game industry because, you can buy a sword in the game, use a sword, enjoy that sword, and then you can trade it to another player. Great. And you may make money on it, on the trade. You may lose money on the trade. I don't know. Depends on what you're doing with it. So anyway, I was inspired by that. So why can't we do the same? So we did. So we're still early on in that phase. It took us 7 years to get to equity crowdfunding to a position, I think, where it's being recognized as a great option. It has so much more potential in the next 5 to 10 years. And the secondary marketplace, yes, it is something that will happen. You allow your investors between rounds of raising money. So you raise money, and then when you're done raising money, then you let them trade. And then you want to raise more money, you stop the trading, and you raise more money, and you keep going on forever until you don't need capital. But the idea of not needing capital, I just don't get it. But okay, a lot of people are like, oh, I don't need money. It's like that's such a bizarre concept. You always need capital. Even Microsoft, by the way, borrows money. I don't know if you guys know that. So come on, please. We're business people. Our goal is to grow the business, and it needs capital.
Jeff, same question to you. How do you approach investor exit? What is the plan for Legion M, and how do you address that in the marketing of your crowdfunding campaigns?
Yeah, it's a great question. I mean, we are very upfront with our equity crowdfunding investors about what Legion M represents. First of all, that it's a high-risk company. I mean, we're a startup company and we're in the entertainment space. So it's like double jeopardy. And the fact is, most startups fail. The most likely outcome of investing in any equity crowdfunding, statistically, the most likely outcome is that you're going to lose all your money. I mean, that's just the fact. But that was the same fact, with Jeff Bezos when Amazon was starting in a garage. It was the same fact for Mark Zuckerberg and, Walt Disney back when they formed those companies. And it's the companies that succeed that can go on and change the world. And so I think, we make a lot of effort to let people know about the risk. Like I said earlier, we treat our small investors or micro investors the same way that we would a large investor. And when there's things that might be obvious to a venture capitalist that are non-obvious to a casual investor, we try and point those out. But the other thing is that we really try and explain to people, like, this is a long-term investment. And, our goal is to, become like Disney. And, it's taken them nearly 100 years to get to the point where they are today. And so, most of our investors, I think, receive this message. And again, it's total counter programming to crypto and, all the options that are available where you can jump in, you can day trade, you can buy, sell, kind of get on Reddit and catch the rise and then get out before it falls and all that sort of stuff. It's completely contrary to that. But it's so much more powerful. And, it's interesting as we talk about like the comparison between GameStop and equity crowdfunding. And I think that is such an interesting example because that is a prime example about how a bunch of small investors banded together to literally make the market and completely change the dynamic. And, and so many of those people were doing it for the reasons that were not even about ROI. It was because they wanted to stick it to Wall Street. They felt like, let's all band together and we can make something bigger than ourselves. And I don't care if I even lose money, but I'm going to hang on to the end because I believe in this movement. And so it was entirely successful, in that regard. But the thing that I think is striking is that it was all built around a stock that didn't fundamentally benefit from it. GameStop was the exact same company, when it was up here as it was down here. And, investing in stock, and particularly a stock like that, is a zero-sum game, right? Which means that for me to make money, somebody else has to lose money. And if you look at GameStop and the rise and the fall, and then it's gone back up, and I'm not sure exactly where it is today, there's probably a few people that made a lot of money. There's probably a lot of people that lost a little bit of money. But if you could imagine if all of those people instead that wanted to change the world had banded together for an equity crowdfunded company, that would have literally been potentially billions of dollars for a company that they could use to actually create something that had enormous value. And then you could turn around and sell it to Wall Street. And so it's so fascinating to me. And I feel like that's kind of the opportunity of equity crowdfunding, this idea that let's all invest our money in the truest sense of investment, not in arbitrage and I'm going to buy low, sell high, but the fact that I'm going to invest my money into something, we are going to create something that was not there before that has the power to change the world. And if it's successful, then we all benefit from it. Everybody, I think is so enormously powerful.
Yeah. Well, Jeff, thank you so much. We are unfortunately out of time. We want to thank you for your time, Jeff and Howard, as well as Mr. Wonderful Kevin O'Leary. So for everyone who is thinking about equity crowdfunding and StartEngine, please visit startengine.com/raise capital. We are waiting to speak to each and every one of you about your business to see if it's right for equity crowdfunding. But as we've heard today, there is no better time to raise capital than right now. And a platform like StartEngine and a method like equity crowdfunding can really be that vessel for your business's future. So Jeff, thank you again so much for your time. And we look forward to your next upcoming raise on StartEngine.
Thank you for having me.
All right. Thank you, everybody. We'll see you soon.